there's a few technical indicators, or standard technical indicators that are available on most Forex and other charts, including the moving averages, Bollinger Bands, MACD, etc. Now, the moving averages in particular is a technical indicator. Personally, I've only found a really tremendous amount of use with in trending market conditions. And to differentiate between a range-bound and trending market, range-bound market is a market that doesn't really make new highs or new lows, but rather stays in a range. We've seen this quite a bit in some of the currency pairs. Now, in other currency pairs, we have trending markets. A trending market is something like the Dow Jones Industrial Average at new one-year highs as of yesterday's close. The gold market at new all-time highs. Crude oil is trying to break out. What we're looking at here is an Aussie dollar. A trending market like the Aussie dollar continues to make new highs or new lows over a certain period of time. Now, we define that period of time based on the time frame of the chart, but the easiest way I've found to define if it's a range-bound and trending market is draw a support line, connecting the most significant lows, connect them on up. Now, in a trending market, more likely what's going to happen is the market will continue to make higher highs and higher lows, or in a downtrending market, lower lows and lower highs, in this case to the upside, and it will not break its support level. It may even form a new higher support level, meaning a support level with a higher angle, a greater angle to the upside. But at any rate, we can consider this certainly a trending market condition. And we see here the Aussie dollar, 91.82, continues to go up and up and up. So we know that the buyers overwhelmingly have control over the sellers over the long term. Therefore, we can consider it a trending market condition, and then we can use our moving averages to plot where we can find trades. Now, what I'll do at this point, there's a technique that I use the moving average. It's a very simple trial and error sort of technique. Let's make this line red, and we'll get started. So I just pulled up the 50 simple moving average. Now, some may ask, should I use a simple moving average or an exponential moving average? An exponential moving average, as I click OK, tends to add a little bit more weight towards the most recent data. So if today the market goes up a lot, it'll skew that moving average up more. Is a simple or an exponential moving average better? You know, I've seen arguments, really bad arguments on both sides of the table. I would say whatever we use, we should stick to it, but I don't think it makes a lot of difference. Now, I'm going to take away the trend line for a moment, so we're just left with the moving average. Now, a moving average in a trending market condition, usually what it does is it marks off either the lows or the highs of that trending market condition, meaning that during an uptrending market, generally speaking, the markets should stay above this moving average because the market now is outperforming its 50 simple moving average, meaning over the past 50 days, the average price of the Aussie dollar is 86.43. Well, we're at 91.79 right now. So very simply, the market is outperforming, and therefore it's above the moving average. Now, what I want to do by trial and error, let's zoom out just a little bit here. Let's go back in time and let's play the what-if game. What we want to do is we want to say, what if we didn't know that all this was going to happen? Let's look to the last most significant low. I'm going to take the lows, and it's a little bit of an art, a little bit of science in using these moving averages. But take back to a daily chart, Aussie dollar, the lows March 4th of this year. Now, the market was certainly above that level. In fact, well, that's not really fair. The market really didn't start to trend until a little bit later. So let's take the next most significant lows, and that would be 69.52 roughly on April 20th. And what I'll do is I'll mark off the horizontal line, or vertical line, I should say, where we're talking about. The red vertical line marks off the last most significant low, assuming we didn't know all this was going to happen in the future. Well, the moving average, see if I can zoom in and still capture this range. There we go. The moving average falls too far below, which means the moving average is adjusted too far down. So here comes a trial and error. On the MT4 charts, it's really easy. Just right-click, and we can change the settings from 50 to whatever number we choose. Now, a smaller number will make the moving average more reactive because we're measuring a lesser period of time. There I just typed in 40, and 40 is a little bit too tight. Why is it a little bit too tight? Because we can see this long candlestick wick down to 69.88 lows on April 28th. That came a little bit below. What we're trying to do is move the moving average. If 50 was too much and 40 was just a little bit too small, let's try 42. And very simply, 42, just to be perfectionist, I'll try 43. What we're trying to do is find the number that most accurately reflects the market's trend, meaning the market came down and tested the moving average, and then what we want to do is find the next period of time that the market tested that moving average again and failed to break below. Well, the next time the market tested that moving average was all the way forward on June 23rd. Market came down to a low of 77.88. This is again on June 23rd. We actually hit low at 77.88. The moving average was just a little bit above that, around 78.30. So about 50 pips lower than that. Well, at that period of time, we could choose to go long or buy on the premise that we do not think the market is going to close or the daily candlestick close below this moving average. On a daily chart, to be very honest, though, we can see it's not as easy because it takes a lot to form what we see on a daily chart. A lot of economic conditions change over time. However, take away this moving average for a moment, and we just note that we are in a solid uptrending market, and it's sort of really, I'm glad it proves this point. On a daily chart, I don't like to use moving averages as much. However, this is focused more towards a swing trader and even short-term trader. If we know based on a daily chart, on the overall macroeconomic condition, that the Aussie dollar is trending to the upside, this is true on a daily chart. Well, I want to look for day trades. I want to look for swing trades. So what I want to do is move to a shorter-term chart. Now, a nice compromise chart I like to use is 1 hour. Nice compromise between the fast movement of the short-term market and still maintaining somewhat a semblance of the overall trend. So now, I'm plugging in, let's say, a 30 simple moving average onto a 1 hour chart. Now, the difference is obviously that as we zoom in here, that when we look at a 30 period simple moving average on a 1 hour chart, it's measuring back 30 candlesticks, 30 1 hour candlesticks. On a daily chart, it would measure back 30 daily candlesticks. So just simply understanding that moving average on a 1 hour chart reflects exactly that. Now we can see the moving average here, the red line, the 30, it's too short, which means the market has a tendency to cross below and above quite a few times. It's measuring too short a period of time, and the market's reaction back to the downside is crossing below it. So we must adjust this moving average. Instead of 30, we'll try 50. We move the moving average out a little bit, and we can see here, well, we pulled back a little bit more, I think maybe apropos, 55. Okay, so we see over here, the market crossed above the 50 moving average or the 55 moving average on August 10th, trended to the upside, pulled back. Now, when it pulled back to lows of 88.64 on October 7th, this is where traders using the moving average would choose to go long because the market rallied up away from the moving average. All this trading activity tells us, hey, we're too far away from the moving average. We have to wait for a pullback. The moving average does nothing more than simply plot where the market could find future support. Now, if we were able to go long and take advantage of it, it was a nice move. However, moving forward, pulling back again, you'll notice a lot of times this moving average strategy that we're sort of going over today, all it really does is it helps look for the next trade. I don't necessarily think that if the 55 moving average worked back on October 5th of this year, I don't think necessarily, and it worked on October 7th, I don't know necessarily it will continue to work. The market's trend, its direction, the strength of the buyers in this case or the sellers, that changes a lot over time. But when looking for the next trade, I think it can be very, very helpful. Let's take a look at the next most significant low, and we have to readjust the moving average. 89.82 lows, October 12th of this year. This is a 1 hour chart Aussie dollar. Well, obviously the moving average is too short. Let's go way out. Let's try a 90 period moving average. Well, 90 actually almost exactly fits where we're supposed to be. Taking a look at the lows, 88, 89, 82 lows, October 12th. Oftentimes, traders will use very commonly used moving averages, including the 5, the 10, the 20, the 40, I've seen a lot. The 90 is very, very common. The 200, I'm sure there's others out there that some of you probably use as well. At any rate, the 90 is a very commonly used moving average. Now, I would not necessarily stick to the 90 just because it's a 90 period moving average, but when it falls out or when it comes out to be the 90, I sort of consider it as an extra source of confirmation. At any rate, from the lows of October 12th, we rallied up from 89.82, ultimately hitting highs of 91.25 and then pulling back. Pulling back again, now the moving average at this point was 90.41, I indicate over here, and we went down to lows of 90.31. So we only went about 10 pips below, including that long candlestick wick. And this is a perfect example how traders will take a moving average, stick it to the most recent significant low, and then look for only the next trade. The next trade, we only came down about 10 pips below our former, where the moving average where we planned it to be, and moving up from lows of 90.50 all the way up eventually to the 92 area. Now, the question is, Aussie dollar moving forward, well, where's the next best trade? Well, we can see the most next significant low is 90.31 on October 13th. Now, the 90 moving average worked in the past, but you know what? I like to consider long candlestick wicks. So I want to adjust this moving average out a little bit to include those long candlestick wicks. I'll zoom in so it can be as clear as possible for everyone. This is exactly what I'm referring to right over here. The date is October 13th. 90.31 is the low of that 1 hour candlestick. And this tells us that now the Aussie dollar 100 moving average plots support around 90.95. Now, is this enough to place a trade? Yeah, maybe, but we have a lot more technical indicators at our disposal. Going back to a daily chart, remember that, well, let's go back to the 1 hour chart and remember that figure. The 1 hour chart tells us a buy at approximately 9100. 9100 is easy to remember. Now, from 9100 we go to a daily chart. Let's see if 9100 makes any sense for any other reasons. Well, we have an uptrending long-term daily chart support line, but that comes all the way down to 8700. So the difference, 400 pips, we're obviously looking at the chart under different time scales. Going back to a 1 hour chart, though, we could also look to Fibonacci. Fibonacci, I think, is an indicator that can always be applied. Take a look at those lows from 90.31, the same lows as we use for the moving average. I like to use the same lows so the indicators that we use understand or, sort of take into consideration the same information, the same price data. Draw your Fibonacci levels from lows to 90.31, October 13th, on up to the most highest highs we can find. Now, I didn't even look at this beforehand. I just sort of hoped that it was going to work out, and it did. Notice these Fibonacci retracement levels that emerged, the lines that emerged in between over here, they represent percentage retracements of the overall trend from the bottom to the top. We take a bottom to the top. That's a 100% move. A Fibonacci percentage plots at certain specific Fibonacci levels, plots where future support may emerge. We have a 23.6, a 38.2, 50%. These are common Fibonacci levels. And the 61.8% in particular, right now, is 9106, just about 9100. So my theory is that maybe if the Aussie dollar pulls back, finds support at the 61.8% Fibonacci level, if and when the 100 moving average, 100 simple moving average on a 1 hour chart pulls up to 9100, it may take another couple candlesticks, but we might get there. And we matched up to the former lows of 9105 on October 14th. And we also know that large round figures, 90,000, 9100, 9200, these large round figures always play an important role. I think it's safe to say, well, a good entry to go along the Aussie dollar based on these 2 or 3 different pieces of information looks to be around 9100. It really helps us wait for the trade. It really helps us trade in the same direction as the trend. As they say, the trend is your friend, and it's certainly in our best interest to trade in the same direction as the trend. It certainly gives us patience, and this is what I really like about this strategy. Now, this does not have to be our strategy for every currency pair all the time. Quite the contrary. As we said earlier, this is a strategy that should be used for trending market conditions. Markets that go up, 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 or down, down, down. Now, let us apply this type of philosophy to a range-bound market, and we'll see why it has flaws. This is a pound-dollar daily chart. Now, how do we know if it's a range or a trending market? Please let me know if you can't see the pound-dollar. Draw the uptrending support line, picking the lows on a daily chart. March 13th, connect the most significant lows April 23rd, and the trend continues on up until August 17th of this year. The market, the pound dollar in particular, closed a daily candlestick below that uptrend support line. This takes away the possibility of an uptrend. In fact, drawing our resistance, which is the opposite of support, connect the most significant highs, connect those highs, and this plots resistance at 64.76. Let me refresh the chart. Alrighty, you should see the pound dollar now. Please let me know if you do not. Or if anybody can, please let me know as well. It's okay? Okay. I'm assuming that's good. Okay. Connecting the most significant highs, resistance moves to the downside. Now, connecting the most significant lows, we can also see here, well, the trend line was broken, but then again, we can draw a little of a downtrending channel. Regardless of that, even if we're not exactly clear, it's a very simple thing to measure. Are we making new significant highs or new significant lows? If we were looking at a 5-minute chart, we would only look back 1 or 2 days to look for those significant highs or lows. But in this case, we can see, well, we certainly did not break below the lows of 136 back in March. We certainly haven't broken above the highs of 170, 171 August of this year. We're not making new significant highs or lows. Therefore, it's a range-bound market. So if we were to plot our moving average by mistake, which we're not supposed to on range-bound markets, well, let's connect the most significant highs. This is a 100. We'll go to a 50 moving average. We're trying to find the last trend that existed. Well, we have that low going back to 143.96 lows, April 22nd of this year. The market ran up, but eventually crossed below. But look what happens here. Market crosses above, below, above, below. When you see the market crossing above and below the moving average consistently, that's not a good sign. I don't necessarily believe that the moving average in this case means anything. So, first step always, define the market condition, whether range-bound or trending. In range-bound currency pairs, and it means it has to be range-bound rather recently, in the last few days, we can apply moving average strategy. Now, let's go to some other charts. This, by far, I would say qualifies as a trending market condition. This is that Kiwi dollar, the New Zealand dollar against the U.S. dollar. Take the most significant lows and connect them on up, trying to establish some sort of supports. Just to be 100% accurate, we're taking the lowest lows of 55.25 on April 28th, connect them on up to the most next significant lows, 61.93 on July 13th of this year. And the market almost gave us another chance to test this on the way up, lows of 66.83 on September 2nd. What would you use for range-bound markets, Jez asked? It's a great question. There are a lot of different indicators. My absolute next point, I promise, will answer that question 100%. I want to go back to range-bound markets, and I want to show you a technical indicator that can be used for range-bound markets and also one that can be used for trending markets to take profits. Because so far, according to this moving average trend line type of application, we only know how to buy. Where do we sell? Where do we take profits? We know we have to place the stops below. In fact, we'll draw another line, not measuring this exactly, understand, just sort of trying to paint the picture of what it would look like. The blue line represents support where ideally we want to go long. Kiwi dollar in this case is 69.67 at current market prices. The red line I drew below, I understand it's not an exact calculation, but just to illustrate, we want to place our protective stops below support, below where we think the market's going to go. Now, let us stick with this chart for a moment. It's such a nice, smooth trend. Let's plug in our moving averages. Let's try to see if a moving average will work on a daily chart. Well, the first most significant low we looked at was going back to 56.21 lows, April 27th. I'm sorry, actually a little bit lower than that. 55.25, April 28th. Now, we plotted the moving average. The moving average turned out to be 50, pretty common moving average, and then the market went up and pulled away from us. Then the market came back down. Now, the moving average told us to buy at 6,300. Remember, it's the next trade, which is the most important one. Well, the moving average tells us 6,300. We came down to lows of 6,270. That is not that bad at all. It's only 30 pips on a daily chart. And we would, just to give you an idea, if we were to go long at 6,300 at the moving average, we would have had to place our stops below the support line, below the 61.93 level, basically 62. We probably would have needed about 150 pip stop. This support line is probably a little bit deep. That's set down at 60.25 or so. At any rate, risking 150 pips from 6,300, where can we take profits? We see we achieved some kind of nice highs down to 68, 6,900. But it's easy for me to say, yeah, sure, I would love to sell at 68, 6,900. We didn't know the market was going to go up this much. We didn't know the trend wasn't going to stop. How do we find a price target? Plug in another indicator now. For this indicator, I like the Bollinger Bands. The Bollinger Bands are simple, a 20 simple moving average, plotted 2 standard deviations above and below the simple moving average. Okay. Bollinger Bands are the white lines. Now, I want to focus on the upper and lower white line. The middle line is just a simple moving average that the Bollinger Bands use in its calculation. I like to use the upper and lower lines. I like to keep them at the standard settings of 2 standard deviations. Now, remember we decided, if we would have known better, to go long at 6,300. Well, we want to take profits when the market starts to touch the upper Bollinger Band. Why is that? Bollinger Bands are typically plotted on 2 standard deviations above and below the simple moving average. Well, for the statistics majors out there, if we take 2 standard deviations, statistically, it's supposed to capture around 95% of the trading activity inside the bands. In other words, 95% of the time, more or less, the market will trade inside, above the lower band, below the upper bands. Okay? Now, that means that if and when the market touches a lower band or above the upper band, or we get below the lower band or above the upper band, that's only 5% probability. 2.5% below, 2.5% above. And statistically, probability-wise, I think that's a good bet to take profits when the market is 2 standard deviations above its moving average. So, in other words, to say very, very simply, I like to buy on a pullback to our moving average, whatever we found to work the best, in this case a 50 moving average. I want to take profits at the upper band. Now, if the trend were moving to the downside, we'd obviously sell high and then buy back, take profits lower. Okay? But in this case, just to give us an idea, to paint the picture, we said going long, the moving average total is 6,300, requiring about 150 pip stop. The market eventually rallied and went finally above, or let's take the last time that the market touched the upper Bollinger Band, 65.26. And then a little bit above that, we ratcheted the highs of 65.60. From 63 to 65.60, that is a nice 250 pip profit, if I'm not mistaken myself. It's not always going to represent the most fantastic risk-reward ratio, but we should try to make more than we're risking. At any rate, it allows us, not only this, and I'll zoom in for a moment just to try to get you excited about this if you haven't already. The reason why I like this is, imagine if for fundamental conditions, I think the Kiwi dollar is going to go up. Well, I think there's a very strong argument it can. I mean, after all, there are much higher interest rates in New Zealand than there are in the U.S. There's a higher expectation of the Reserve Bank of New Zealand will raise rates before the U.S. After all, the Reserve Bank of Australia just raised rates last month, or not even last month, just a few weeks ago. So I think the Kiwi dollar trend to the upside could continue for some time. Now, with that said, if I have that foresight, if I have that vision moving forward fundamentally, and I'm a super long-term trader, and I want to buy Kiwi dollar and hold on to it and try to make thousands and thousands or at least hundreds and hundreds of pips, well, we can use this approach in the same way. Remember, this is a daily chart. This trend has persisted from March of this past year, near lows of 50. We're now at 7470, almost 7400. That's a 2400 pip move already. Now, what I would do in this case, or what I would like to do if I were a long-term trader, is that if we decide to go long the Kiwi dollar, remember the 6300 entry, and then we decide to take profits at the upper Bollinger Band, instead of selling all the profits, take half the position off the table. In real-world example, let's say we open a mini account, depending obviously on how much you fund the account with. We buy 2 mini lots down here. Well, we say to ourselves, I'm going to place a limit order automatically. I'm going to get out of half the trade. I'm going to sell 1 mini lot at the upper Bollinger Band. And very simply, every day, it's a daily chart. We have to update the trade once a day. Every day, we see where the moving average is now, the upper Bollinger Band, and we adjust our limit order, maybe a little bit below, just to try to grab some profits. And then if we're able to do that, if we bought 2 mini lots down at 6,300 and we're able to sell 1 mini lot at 65.25, and we made a cool 125 pip trade, well, the next question is, where do we move our stops? Well, we could continue to move them, but I'd be cautious. Keep the stops below the last swing lows. But more importantly, after we've taken half of our trade off the table, we've booked into profits, then I want to place an entry order to buy back that second mini lot the next time the market pulls back to the moving average. So even if we've missed it, we are able to get back into the trade if and when the market pulls back. We would have had to wait some time. In fact, moving all the way forward to September 2nd. But imagine the possibility of checking the charts once a day, adjusting your stop order, adjusting your limit order, and your take profit order, and as long as the trend continues, and it's continued from March until now, we have the ability to get in a trade, stay in a trade as long as that trend continues, and hopefully take advantage of all the big moves to the upside. Now, I'm missing questions. Question is, how do you best use a combination of 3 moving averages, and which one's your favorites? It's an excellent question. You ask 3 traders, and they'll probably give you 4 different answers. But I will tell you this. The moving averages, I like to always consult the more commonly used moving averages. The 20 simple moving average, and I like simple moving averages more than exponential, just out of habit. However, the 20 simple moving average I like. Why? Because the 20 simple moving average is a center line that's always used in the Bollinger Bands. If we were to change this 20 to a 30, it would change the Bollinger Bands. So for no other reason than the self-fulfilling prophecy that if you watch a 20 and I watch a 20 and everybody that's using the Bollinger Bands is watching the 20, and the next thing you know, these trading robots and automated systems, they also use the 20, well, then I want to watch to see how the market reacts to that level. After all, if I have a buy order in the 20 simple moving average and you do, and a lot of other people do, the market just might stop there. I don't think the market necessarily stops because it's a moving average. But for some reason or another, it seems to work. Other moving averages I like, well, if I had to pick 3, I would tell you the 20, the 45, and the 90. 45 is half of 90. 90, I think, is probably one of the most common by far. Now, would a 20 moving average not be better? It's a great question. And to answer Isaac's question, both these questions together, my favorite moving averages always change. What I mean by that, and I'll take away the Bollinger Bands. Notice the last most significant lows. We came down to 61.93. Actually, you know what? Let's go a little bit above that. Let's really try to find the next trade. Well, the last most really significant low that I haven't seen in a while is 66.83 on September 2nd. I want to get this moving average up to that level. So I'm going to try a 40 moving average. The red line comes up. It's a little bit above. We'll try 45. 45, a little bit too low. I'm trying to look at match the daily chart bottom of 66.83 on September 2nd on a Kiwi dollar daily chart. So 45 is a little bit too much. We'll try 42. 42 seems to be about right. We can see the Kiwi dollar now projects us a possible buy order at 7,100. So to answer your question, Kiwi dollar daily chart, my new favorite moving average is a 42 simple moving average, just because it fits with the curve. And you took the words exactly right out of my mouth. It is curve fitting. Curve fitting is a term that I think it has a very bad connotation with traders. It refers to those of us that we're involved in, let's say, program trading, where we'll program a computer. I want to test. If I would have bought the Kiwi dollar every single time, when it touched the 20 simple moving average, if I would have placed my stop there and my limit there, how much money would I have made or lost? And these trading programs are fantastic because you can test every single moving average, from the 1 moving average to the 200 moving average and beyond. The problem is markets, trends always change, conditions change. The market still at its root essence is somewhat random. That's why curve fitting is bad, because curve fitting showed us what did work the best, but that doesn't really help us. What we're looking for is what will work the best in the future, in the near-term future. That's why I say with a moving average application, I think it's only effective, really effectively, for the next trade, only the next trade. In other words, we plotted our moving average here. This is a 42 moving average. We never got a chance to come back down. Could we pull back down? Sure. But let's look for the most next significant lows after that came up. Well, the market rallied up and saw a big move to the downside, 69.63 on September 14th. I want to match this low now. I want to curve fit. So we're going to move to 25. That's not enough. Let's move to a 20. Still not enough. Let's move to a 15. Well, we can see here the 15 is not even enough, but it did match our other most significant lows. And even more recently, it matched our lows at August 12th. So it is curve fitting. And it certainly is, I think it can play to our advantage. Now, Abel said what I was about to say, asked what I was about to say, and I'm not forgetting your question, Trade Doctor. But Abel mentioned something that was my next point. Compared to a trend line, which is better? Which is better, to buy on the trend line or to buy in the moving average? Well, my answer to you would be both. Ideally, what I would love to do, remember this daily charts? Well, the moving average, the blue line, take away the red line, the blue line represents our trend line based on a daily chart. That's ideally where I want to buy in terms of the trend line. 69.76 currently Kiwi dollar. Now, what I would love is that if the market pulls back enough over a period of time, and if the market pulls back, we would expect the moving average to dip back down also. I would love to buy. A great case scenario would be to buy when the market tests the trend line, when the trend line is very close to its moving average. That's what I like when different technical indicators agree on the same level. That's what I would really like. Moving forward, zooming in, I should say, not moving forward, draw Fibonacci lines, for example. Fibonacci lines can also be used. Take the significant lows. I just seem to like this low for some reason. 66.83 on September 2nd. Draw it on up to the next most significant highs, and we see the market pull back to the 38.2% Fibonacci level, right where the mouse is. Well, if that's our next significant low, we'll draw that low up, draw the next most significant high. I'm going to zoom in on the chart so we can see. And then we see the market again pull back to the 50% Fibonacci level, and coincidentally, maybe not coincidentally, the 15 moving average intersect. That's what I was looking for, that intersection, a Fibonacci moving average, or a trend line and moving average, or trend line Fibonacci and moving average. And all those great tools come together and tell us, hey, 72, 7250, 7300, that's a big level for a couple different reasons. I can show you another reason. Draw a horizontal line, draw 7300. In fact, we'll drag it down a little bit to the lows of 7230. Why is 7230 important? It's the highest closing candlestick on September 30th. Notice how all the long candlestick wicks really, really tried to break up above 7200, but then failed to. Well, the precedent is eventually, when we break above our ceiling, above resistance, oftentimes it becomes new support. I know I'm throwing a lot in all together, but just trying to paint the picture that my favorite trades are the result when you have different unrelated indicators that seem to agree with each other. Trend lines are unrelated to Fibonacci, which are unrelated to moving averages, etc. Now, let's get back to the questions. And he says, so you are in effect using the probability of each curve. Absolutely. Absolutely, yes. We're just trying to find the probability of the next best trade. Trading with the trend when such a steep, definite trend exists, I think really puts the probabilities in our favor. After all, taking a look back at the Kiwi dollar chart, I'm going to erase all these lines. All these lines, and we're going to take away the moving average also. We're going to forget everything we know. We're going to take a look at the Kiwi dollar from the lows of March until the highs today. Okay. Now, if I had the free time to count every single candlestick from March 5th until today and count how many green candlesticks versus red candlesticks there are, I would venture to guess, just guesstimating, I would say about 80% of the daily candlesticks are green and 20% are red. Let's say even if I'm giving us too much credit over here and it's only 70%. If I knew back in March, if someone gave me a secret crystal ball and they said, listen, October 15th, you will look back at the charts and you will have seen that 70% of those candlesticks closed higher than they opened. I think without using any other indicators, I would use a wide stop. I would buy in the open, place an order to sell on the close if I know that 70% of those candlesticks are going to make money. In between, within every single candlestick we have, I would venture to guess a lot more green 1-hour candlesticks than red 1-hour candlesticks. So to define the trend and to trade with that trend is the first step to put the probabilities in our favor. The moving average is refining that probability even more by stating, okay, on a 1-hour chart, what is happening, which reflects what is happening right now, the probability is, well, based on the last pullback, that the market is stopped at the 20 simple moving average. So I'm making a bet. I'm making an educated guess that the next time, only the next time, it'll probably be pretty close. Let me continue with the questions. Now, Trader Doc's comments on the SMA versus the EMA, they are both extremely helpful. I used to use the EMA. I don't know why I started using SMA. I just like the idea of having a moving average that gives us an exact even division of the, meaning if you have a 20 simple moving average on a daily chart, it looks back 20 days, takes the closing price for every day and divides it by 20. I like that it's simple. The math seems to be simple. Exponential moving averages, the way the math works, adds a little bit more weight to yesterday's candlestick, meaning the last candlestick on the chart. So, I'll plot it in so I can demonstrate exactly what this means. You can use either. Really, either one you can use. I use simple for no other reason than just, well, no other words, it's simple. Okay, so I plotted here a 20 simple moving average, and now I'm going to plot a 20 exponential moving average. And there's other moving averages also. One of them, I'm going to change the colors so we can, okay, so the simple moving average is red, the exponential moving average is blue. Zooming in here, this is a daily chart, we can see the difference. The market's moving up at a little bit of a fast clip right now, so the exponential moving average, if I remember what I did right, is a little bit above. Sometimes when the market pulls back, the exponential will cross back below. They are both 20 moving averages. The blue is exponential, the red is simple, but I'm sure you can see that over the long term, I don't think it makes a lot of difference. The pips, even on a daily chart, are negligible. I mean, take a look at the separation we have on October 4th. The exponential moving average was 71.25. The simple moving average is 71.07. So we're not looking at more than maybe a 15 or 20 pip difference on a daily chart most of the time. Now, moving forward, when do you consider crossovers? Abel, I hope I answered that question in terms of the simple versus the exponential in regards to trading with trend lines. I would say either one, but stick with the one that you start with. When do you consider crossovers, moving average, so-called golden points? It's a different, let me answer your question. It's a different application to moving averages. I have a blue line, which is a 50 simple moving average, and the red line is a 20 simple moving averages. Again, the red is 20, the blue is 50. Now, some traders, some strategies, what they do is they call for that you would go long, that we would buy the Kiwi dollar when the short moving average crosses above the long moving average. Short means 20, long is 50, longer period of time. And the strategy dictates, hey, I'm going to buy the Kiwi dollar as soon as the 20 crosses above the 50, meaning that the market is moving up so fast that it's pulling the 20 up faster. The 20 past days have been moving up a lot faster than the 50 past days, most recent days. And the strategy basically gives us a trigger. There's a further application to it. I'm not really doing the strategy justice. I don't particularly like this strategy. I think that if you're going to use the strategy, sure, you can use the crossover, the short moving average crossing above the long moving average as the trigger to get in. But again, if I like to buy when the market pulls back to the moving average, I'm waiting for the entry. If I wait for the crossover, after all, the crossover that took place on March 23rd, remember, on March 23rd, the market closed at 56.98. The moving average I want to buy is at 51.83. So my point being is if you wait for the crossover, we're going to miss a trade. Wait for the crossover, but always wait for the pullback. Do you use other tools to determine when to take profits other than the Bollinger Bands? Absolutely, yes. I'm certainly glad you asked that question. It's a great question. I will go back once again to Fibonacci. I think it's the one tool in foreign exchange that I cannot live without. Taking a look at the daily chart Kiwi dollar from February 28th of 2008, there are very, very big highs on the 8100 level. Draw Fibonacci levels from those levels all the way down to the lows of March. Now remember, moving down is 100%. We drew the Fibonacci levels down 100%. The lines going back up represent the Fibonacci percentage retracements. From the bottom, we retraced up 23.6% of the entire trend. Then we retraced up 38.2%. The 78.6%, not as commonly used as the others, but certainly very important. It is the last semblance of hope for Fibonacci. Now, what does Fibonacci tell us? When the market goes up or when the market goes down in a trend, it's supposed to go up or down. It's like we're walking up or down a flight of stairs because we go up a little and down a lot, up a lot and down a little in an uptrending market. In a downtrending market, we go down a lot, up a little. Well, if this overall picture, because we drew the Fibonacci levels, I should say, from the top to the bottom, we're anticipating continuation of the downside. Well, the 78.6% is the last area that the Kiwi dollar should find resistance. In other words, if we break above 7,500, which represents a 78.6% Fibonacci retracement level, it takes away the possibility of a downtrend and gives us a very good shot to revisit 100% highs. In other words, Fibonacci tells us, yes, we could stop here, we could stop here, we could stop here. But in the realm of 5,000 to 8,000, about 3,000 pip range, it doesn't tell us where the market's going to stop, but it gives us 1, 2, 3, 4, 5 levels the market's most likely to stop at. Now, just because I typed in, I don't want to miss any of the questions here. Another question, though, use Fibonacci expansion, also known as Fibonacci projection levels, if I understand your question correctly, and I do. The way it works is this. We're taking a look at the Kiwi dollar from the bottom to the top. Draw your Fibonacci levels. Last most significant high back in, March of this year, up to the highs of April. 1 month, I'll zoom in. So we drew from the lows to the highs. We pulled back to the 38.2% Fibonacci level, and then we jumped forward, and the next most significant high was the 50% Fibonacci projection level, if I understand expansion to be the same thing as Fibonacci projection, meaning you take the same Fibonacci percentages, and instead of subtracting from the top, you add them to the top. This gives us price targets. Nice double top at the 50% Fibonacci projection level. So, absolutely. To answer your question, I do use other indicators. Fibonacci projection and retracement levels, I think, are probably one of the most important. Which combination of crossover, moving average, EMA have a good probability of giving time frame 1 hour charts? The answer, Ritesh, is always different. I would simply, number one, define a trending market on a daily chart. Number two, once you find that, like the Kiwi dollar, I'll tell you what currency pairs I think are trending very nicely right now. The euro dollar, not a great trend, but the euro dollar is trending to the upside. I think even 5%. Euro dollar, Aussie dollar, Kiwi dollar. Also consider Aussie yen, Kiwi yen. If you look at the daily charts, you'll see why. Gold, oil above 75. You'll see why if you look at the daily charts. And the Dow Jones Industrial Average. And I'm leaving out other equity markets, I'm sure. But just to name a few, those currency pairs have defined very, very strong trends right now. Oh, yeah, by the way, dollar CAD and maybe dollar Swissy. But I think that what we're looking at over here is the dollar crosses. To answer your question, Eric, I would say that the dollar crosses have been leading. The dollar's been a lot weaker than the yen has been. But if you ask me, I think the yen will go down like the dollar has gone down. I think the next greatest short could be the yen. Eventually, the Oz and Kiwi. But the yen is moving down very, very fast right now. Dollar CAD has also been screaming to the downside. Now, the question, Philip, as I'm almost out of time, do you take fundamentals into consideration? Absolutely, all the time. The fundamental picture is what I started out with. And in my last 30 seconds of my webinar, I would just say this. To start with the fundamental theory about the market, it's very, very simple. Very simply think, well, in a currency trade, I want to buy the currency that is most likely, has the best probability to go up, and sell short another currency that has the best probability to go down. Well, what's the number one reasons why currencies move? We say this over and over again. The anticipation, the expectation of higher or lower interest rates. So first, fundamentally, think about the foreign exchange market in terms of what currencies do I think can go up soon? Which countries or which economies have the highest probability of rising interest rates? To answer your question, my number one, number two picks is Aussie, Kiwi. After that, maybe a euro, maybe the Canadian dollar, but those two, it's a big maybe. Which currencies have very, very low interest rates? We can't say they're likely to cut because a lot of these currencies have zero interest rates or close to them, but I would anticipate that we will not see rate hikes anytime soon based on most recent data in the yen, with Bank of Japan always keeps rates low. The U.S. dollar, I don't think the Fed's going to raise rates anytime soon. Swissy rates are pretty low also. But then again, we could say euro rates are pretty low also. So I want to put those higher yielding currencies against the lower yielding currencies, find on the charts a trending market condition on a daily chart, and once we find that, then go to the 1 hour chart and just by trial and error, find the moving average that seems to frame the market in to the best ability. Question, my fib extension includes retracement, says 123. Yes, a lot of times the Fibonacci's will use 100% plus a Fibonacci, 123%, 138.2, or 138.2%, 382%. That's what I'm trying to say. How often do I pay attention to stochastics trending markets? I don't use stochastics. Nothing to say against stochastics. But with moving averages and Bollinger Bands and trend lines and Fibonacci, my plate is full. Stochastics is another way. It can be a great substitution for the RSI, I think. So looking for a carry trade, currencies gives us a good fundamental look. Absolutely. Absolutely. Focus on the carry trades. Take the highest yielding currencies against the lowest yielding currencies. That's the most simplistic way. But if you want to take that to the next level, read, our central bank reports, pay attention to the news to try to get the best opinion. Bloomberg.com is a great website to use, as is DailyFX, as is FX Street for that matter. These news-based websites can certainly help us form an opinion which economies are doing better, which are most likely to raise or lower interest rates. I am out of time. I really wish I wasn't. However, if you do have any questions, please do not hesitate to contact me directly, www.forexlounge.com. We host a number of live trading sessions, live trading services, including trade signals, SMS, fundamental analysis, much more. Contact me there. We want to thank you all very much for joining us. A very special thanks to FX Street. We will be back on the air later on this calendar month, so please see their calendar. Again, we thank you for joining us. We wish you a great day. We wish you all profitable trades, and we look forward to seeing you next time. Back inside FX Street.